Hey, yeah, what? Grab your bootstraps, yeah, let's scale your growth. Here's the truth, Jack. We'll reach the globe, unveil the notes.
What the
Pivot, earn your digits, won't burn, you'll get it. See, this is factual. Funds will show, learn to flow with Candid Capital.
This is a Candid Capital bonus segment. In this special episode, we capture live from the Candid Capital Innovators Forum event. Topic: tokenomics for startups and investors, navigating the Web3 future. Luca Bazzurro, token economics mentor at Startup Wise Guy, explores the topic of token design in building a startup and considerations for Web2 to Web3.
Are we good to go? I think we're good. Okay, please go ahead. We're listening.
All right, great. Thanks very much. So, as I said, thanks, Josh, for inviting me. I will try to speak slow because I think it's still a bit jumbled.
No, it's better.
Okay,
You're all good.
because I hear myself a little bit, but yeah, it's great to be here. And today I will try to talk a little bit about token design, which has been my job for a while, specifically in building blockchain startups, obviously. A few considerations, do's and don'ts, and so on. Let's start. Okay, so this is the brief agenda. First of all, I will talk about the intersection between blockchain and economics, few key principles of token design, some common mistakes that I've encountered around these last 7 years. One case study of maybe a good example, and then I will allow time for Q&A, because of course I'm sure people will have a lot of questions. I hope so, at least. So a little bit about me. I've started working in crypto in 2017, so it's more than 7 years already. I've worked as a economic designer for more than 60 projects. And I've been to countless events, like the one you're now. Definitely the most impressive thing is that I survived 2/3 bear markets, depending on how you count them. I launched a gaming startup, and but mainly I was consulting different companies and project VCs on creating or improving on an existing token design. Very brief intro is that basically blockchain is an innovation that is intersection between 4 areas. I don't want to talk about the first 2 because I'm not very well versed, which are computer science and cryptography. So I will focus on microeconomics and game theory. As you probably know, microeconomics focuses on the decision making, on the behavior of society as a whole, over an ecosystem. And every blockchain platform can be considered as an ecosystem. So these kind of factors are important when trying to build a digital community and to build economic incentives for it. Game theory, on the other end, is more on the micro side, and it's basically a study on how competitive strategies and participant actions can cause an action, how you get to a certain outcome, why, how can you nudge a desired outcome, and what not to do also. Going on with the introduction, I wanted also to give a little bit of understanding of the differences between Web2 and Web3. I will maintain that it's not completely new. There are some things that can be used, some teaching from Web2, specifically in the last 10 years, that can be used in Web3. But the main difference is being that the Web2 structure usually is a permissioned one, whereas in Web3 is permissionless, which means that everybody can access without asking anyone about it. Web2 is a lot about intellectual properties, where Web3 is usually open source, the code, but also most of the rest. I maintain that Web2 have more educated users for sure, and Web3 on average are people that are uneducated about all the tools and all the specifics of it. I mean, as an average, consider how much you understand how Amazon works or how much you understand DeFi, you see. Then definitely Web2 is characterized by a centralized governance, whereas Web3 is, or should be, that's why I put a question mark, should be decentralized. Apparently that's what we say. Is it, isn't it? We can talk about it. Web3 is also characterized by a low user ownership, which means that the content and product is not owned by the end user on average, whereas Web3 aims at high user ownership, via tokens, via NFTs, via various different tools. Okay, this is important, I would say. I would like you to consider a Web3 project as a completely new version, a completely new blend of a conventional enterprise, let's say a startup, about the new projects that has to make money, revenues, profits, of course, business model, but it's also intertwined with sort of a sovereign entity kind of structure, because, again, decentralized governance, proprietary token most of the times, or tokens, voting, well, the decision making is shared. So it's difficult and challenging to try and figure out how to best navigate this. But I will say that considering a Web3 project as the fusion of the two things might be beneficial, might help us understand how to move forward. Economic design, which is what I want to talk about, it's a broader term compared to token design or tokenomics. Tokenomics usually is the distribution of a token in terms of how much should it go to the advisor, to the public, to a private sale, and so on. Token design, of course, is the design of the token and its economy. Here, I take an even broader approach, which is economic design, which is every single economic decision and incentive that you try to design in a specific blockchain project. And it's important to take a broader look in the beginning, because the economic incentives are what drives human behavior usually, and blockchain technology has the tools to, one of the most important of is tokens, to incentivize and reward users. I divided the two things because it shouldn't be considered only as a reward, as a bribe, or as any kind of monetary reward, the token itself. Or in general, in economic design, there are not only monetary rewards, there should be other kind. For instance, reputational rewards, it's one. Governance votes. So relevance in the decision making. So yeah, that's basically it. The objectives of economic design is basically fostering economic growth, definitely community building, obviously, because if you try to design, this is where game theory comes in. Usually you try to design the incentives that are maybe to create a competitive landscape between the users, but in a way that fosters the creation of common goals. And this in general creates engagement and creates community, the sense of a community. Ideally, you want to try to establish a circular exchange of value too, which means that value doesn't leave your project, your ecosystem, but stays in. And in this case, with a token flows from a user to the project, back to the user, or in a more complicated way usually, but this usually drives value and helps the economy grow. And also can be used to gather data and insights on user behavior, because through the way all the stakeholders in an ecosystem perform economic choices with their time or their money. It tells you a lot about how they perceive your company, how they perceive the project, what would they like to have in the project, which kind of feature they like better, and so on and so forth. This is very useful. There is a whole branch of it that I'm not going to touch too much on, which is called mechanism design, which aims at actually resurface information that is private, gather it from all the stakeholders, specifically from the users, mainly from the users, and feed them to the company that is owning or managing a blockchain project, in order to inform better decisions or create better models, do better analysis, and ultimately improve the business model. Okay, this is another point that I like to make clear in the beginning, especially since I talk about circularity, and so on, and token flows. It's always about the flow and never about stasis. So the digital economy is a very dynamic ecosystem, and a digital economy I use to compare, to make it simple for everyone, to a living organism. It grows, it changes, and that means that all the economic designs, all the incentives, and even the token design itself, even the tokenomics, should be improved and fine-tuned through time. It's important to make it right in the beginning, obviously, but it can never be considered as static. And also the data should not be considered as static. Now I want to make a brief distinction, since I spoke about token in general, tokens. But the truth is, there are two main names for fungible tokens, not considering the NFTs right now, which are cryptocurrencies and tokens. Cryptocurrencies are the native assets of a specific protocol. So like a layer one asset. Example can be Ethereum, Bitcoin, Near, Solana, Cosmos, Polkadot, they are usually used as commodity. That's why they're called gas price and so on. Whereas the tokens are the currencies created by protocol, by dApps or digital applications on top of existing blockchains. So MakerDAO, Aave, Uniswap, It's not so useful because everybody forgets about this, but maybe it's a good thing to keep them separated and know that one is more used as a commodity again, and the tokens actually have a broader scope. That's why I'm going to expand a little bit on the second part. Types of token, again, are many different. There are many different types. Can be security, asset-backed, all the tokenization that is happening right now, it's basically falls into this category. And there are the famous or infamous utility coins that are technically tied to a definite use and have one or more use cases. The stable coin, obviously, usually tied to the dollar, but now we see the insurgence of euro-backed, Turkish lira-backed, yen-backed stable coins. Of course, are coins that keep their value over time, pegged to a fiat currency. And then there are governance tokens, which usually are for voting, for decentralized decision making in the digital ecosystem. The most important part here is that some of these do not harmonize well with each other, which means that, for instance, you can have governance pretty much with utility, like utility and governance go well together usually, because you can power a specific use case and still give the user, because it's supposed the utility token is supposed to be used by a user. You can give them a say in what's going to happen in the project if you want. But for instance, trying to have stable coin and also utility coin might be complicated. Especially could be complicated to have a security and a utility kind of coin together. Obviously, if you look at the name, they are different, but Sometimes I've been asked in my career to create a coin that can be used for auto transactions and that is reliable and fast, but also, and this is the utility part, utility function, but also that we can sell to the investors and that has a value that goes up in time based on the value of the project. And I'm like, yes, but one should be stable in value, because if you want a utility coin, usually the best, especially if you have a business to business kind of project, businesses have to put in the balance sheet how much they spend for a specific, product, and having a token that is completely volatile is not very, very cool. On the other end, and you want it to be very liquid. If you have a different kind of coin that is more sort of stock-like, that you want to peg, let's say, or anchor to the value of the project itself, you want it to be less liquid, definitely, and volatile, possibly upwards. So you see these things don't mingle well together. So it's very important to see that there are trade-offs in building tokens and token models. And those are some of the first things to consider when evaluating a design or evaluating how to create a new coin. The use cases are multiple, as you're probably familiar with. The most common examples are payments, remittances, donations. Can be used in charity, can be used in pretty much anything, because blockchain is usually incredibly fast compared to the traditional finance, way cheaper and more secure. Another big branch of crypto that is expanding and actually exploding right now, it's real world asset tokenization, meaning tokenization of real estate, tokenization of T-bills. You can tokenize commodities like gold. There are already projects doing this. Pretty much any physical asset of value. Sorry. Then, of course, can be store of value. Pretty much what Bitcoin is doing, voting, and then sky's the limit, honestly, because they are used for everything. I mean, they will be used for everything, but there are many use cases. Sometimes loyalty points also now, more like this kind of fidelization mechanism, or e-commerce. Really, there are so many, but I digress. Now I want to talk to you about some of the common mistakes in design overall, which are very important, I think, because there were many in the beginning. First and foremost is overcomplicating token design. A lot of the times you can see like a project that is trying to do that is completely new, maybe it's in alpha stage, comes to you and say, our token can be used for payments, can be used to invest, can be used to stake. It can be used to mint NFTs. So you can send it to your mother. You can send it to buy groceries for you. I mean, really like everything all together. And it's kind of complicated. There is a learning curve here, and it's not easy to educate a user that maybe, especially when the same project maybe tells you, we are going to attract 1 million users, or we're going for the Web2 users. And it's very complicated, to do this when you have so many use cases all together blended in the beginning. It's like, when in the normal, I would say, this happens also in the normal startup world, when some new companies want to do everything all together all at once. And it's also why it's also a mistake. Not only because it's cumbersome to understand by the end user, but also because the more complicated you make, the bigger the chance of making mistakes, Also, because as I said before, there are trade-offs in the design. What if you create conflicting characteristics? There are many more things that can go wrong than they can go right if you do it very, very structured and complicated from the beginning. Another problem that is getting better now, but it's a lack of transparency, which is basically founders being unclear on what the token is for, how to use it, the way they manage the reserves or the treasury, you know, especially in a world like blockchain where reputation is very important. Economic models being just inadequate, it's another mistake, which means when you maybe not create a trade-off in the incentives, but you create very simple ones, let's say, but they are conflicting with your business vision. They are not empowering you, they're not letting you monetize what you want to monetize on, for instance, or they create disincentives in people. For instance, some project promotes to have instruments like staking and so on when they are claiming that they want the liquidity of the coin to be very high and the velocity of money very high. To create a lot of systems to remove the coin from circulation, you actually reduce the liquidity. So you're going in the opposite direction, these kind of things. If you have questions about this, we can explore, of course, later. And then poor governance structure, definitely, when maybe you try to decentralize the decision-making process too early, for instance, and let everybody vote. But again, maybe because the token design is too complicated, people are not really educated on what you want to do, what you're trying to achieve, or people are not very committed because you haven't built the right kind of community yet. You attracted too many speculators and they vote selfishly, and you let them vote on things that maybe are too difficult, and maybe not let them vote on things that can give an added value for the company as well. I mean, and then you can compose all of these. You can have all four together if you want. And there are more, but these are the main ones. These, just to scare you, is what happened when you mess up, which happens a lot. It happened a lot. These are some of the headlines of last year, where you can see even big projects having to fix their NFT economy, fixing their tokenomics, changing this, changing that, because they didn't consider the whole story, or they were a bit myopic, maybe in getting the funds in the beginning. Can be a lot of reasons. But what's the problem here? If you change the token design later on, there is a huge reputational damage, first of all, which is very important, especially in Web3. And it's very, very hard to do anyways. It's much easier to add a feature than to change it when, especially in the beginning, if you're in test phase, you're giving out the tokens, for instance, it's easy to fix a couple of things. If tokens are already spread, bunch of different people, even if you change the reward scheme a little bit, it's not gonna tip the scale too much sometimes. So it's really like the downside of a bad token design in the beginning. It's not to be seen in the first 6 months. This is why also it's getting to be a bigger topic now, because there was time enough for companies in Web3 to show the mistakes they did in an economical term. So these kind of things come up later on, and then they're very hard to fix. This is the point. Now, that's on the bright side. Let's talk about some of the good, what a good token design can allow you to do, and how it can help you leverage a better digital ecosystem. Well, first of all, it can a good token design can allow users to get educated about your project at their own pace, and to get involved and engaged at their own pace, usually, if it's done properly, which is very important because the attention span it's smaller and smaller. So it's not okay to go read if you have your economic design on your white paper and it's 30 pages, nobody's going to read it. If you have a video of 1 minute, 10 videos of 1 minute explaining every single feature, it's much better. These kind of things are how to communicate the design, but it's already part of the design itself. So It has to be easy to understand, definitely, for anyone, especially for your target audience, obviously. So if it's a DeFi project, for instance, users usually are a little bit more educated. So it's okay to have a little bit more of a technical explanation of things. But for other kind of business sectors, it's important to be much more like ABC, much more one-on-one. It has to be easy to use, especially. So once you understood what the design is about, what the token is about, and so on, it's important that a person, it's the UX, the UI, user friendliness in general. It's very, very important, especially Web3, where, let's face it, the UX is not great so far, especially compared to Web2. It has to fit the project business model again. So, for instance, if you're a startup and you wanna you created a product, whatever it is, and you think you're gonna monetize on a certain subset of the users, the token design should help you do it, not hinder your ability to do it, or not just reward everyone. If you want to reward a specific user for a specific action, it has to be able to do it. If you need more developers in your ecosystem, you can create a reward system for them specifically, not for everyone. These kind of things, and that's why also, going back to my slide about dynamicity and so on, it's important to revisit it, because the landscape changes and you can try to adapt the design a little bit on fitting your new business model. And then it ultimately needs to help a community building, which means the sense of a community, because if this is going to work, especially B2C kind of startups, or B2B2C, which is the most common now, I would say, among the new projects, or you ultimately want committed users that don't feel like clients, but they feel more like, again, part of the system, part of something bigger than themselves. And it's not just rhetoric. It's true that if you empower the user, it will give you better information about his preferences and his interest and so on, and it will feel more entitled, and it will be harder to lose users and so on and so forth. To make an example, I brought BNB, which is Binance Coin, which is one of the few early stage token design that I think were spot on. Why it was like this? Because in the beginning, it had only one use case. So going back, easy to understand. What the coin did, trading fee rebates. If you pay the fees in Ether or in USD, you pay $1, let's say, for a trade. If you pay with BNB, you pay $0.50. Easy, no? Anybody can understand it, especially if you're already using a centralized exchange, you're there to trade, it's obvious. So easy to understand, easy to use, fit the business model, because they were not latecomer, let's say, but there was already Kraken, Coinbase, and so on out. In Korea, they were huge, OKX, and so on. So this definitely fits their business model, because helps them to get traction and so on. And that's exactly what happens. And then he slowly added feature, which is exactly the way to do it. Very easy in the beginning. And then when the situation arises, first of all, you collect data on the behavior of people, not in the Google way of, selling the data for something else, but just, you see how the people use your coin for what they would like, what new feature they would like to have. And when they had, for instance, they were approved to issue a credit card, a debit card, sorry, then cashback was in BNB, easy, The learning curve was smooth. Then they had ultimately their own chain, and of course, it's going to be powered by Binance Coin. Now they have the launchpad. You can invest in in Binance Coin, you name it, but they just added one feature at a time, and this way you smooth the learning curve for the user, and it's pretty easy, and then everybody knows what they're doing, and it's a virtuous circle. The more empowered, the more educated the user, the more it's going to use the product the way you want to, the more revenues for you, the more money you have to create, to expand your business, and then create new features, and so on and so forth. The fourth feature of the model was the buyback, let's say, which is, I put it on under air quotes, because they don't really buy back. But the idea was to take 20% of their profit and use them to the equivalent in BNB, burn it. But they call it a buyback, but as you probably know, for a buyback to happen, you got to go to the market and buy, actually, in this case, your coin back from the market. They just burn it from their reserves. But still, this gave the idea to users that there was sort of, a common incentive. As I said, competition, maybe trading competition, who trades most in this week gains something, but at the same time, collective reward. The more collectively we spend on in BNB on our platform, the more we burn. And at least it helps reducing their reserves and making them more committed, to the growth of the company through the coin. In conclusion, to wrap up, it's not really about efficiency when you try to create a new token, but resilience. It's much more important not to go down, not to go to zero, because there is no way up, than to find the optimum, perfect design for your coin right now, especially because the conditions change so fast. It's not even only the tech. Tech is already a very, very fast sector. Blockchain is tech on steroids, So you might even get the best design ever, and in 3 months you have to the assumptions are different anyway. So it's much more important to focus on not to mess up, or not to get to zero, not to get only speculators in your business. That's not what you want. So flexibility is key. That's pretty much the takeaway. Thank you. And I will take questions if we have time.
All right. So we're going to do the different questions. We'll start with a couple from the audience here. All the questions have to go through the mic in order for everybody to hear. So start with Mike.
Thanks, Luca. Great presentation. I have a question pertaining to one of the slides in the middle of the presentation on different use cases for tokens, and one of them was real-world assets. And my question is, if you start basing tokens on real-world assets, don't you run into the same issue as with oracles, where you still have to rely on like a single source of truth or a single source of control to associate a token with an asset? Like, who's controlling the real estate, for example, that you've tokenized? And I know this is becoming a subject of conversation in many circles, because BlackRock is now promoting tokenization of real-world assets and stuff. So I just want to understand how you port the physical world to the digital world without passing through centralized intermediaries.
Yeah, that's a good question, honestly. And I agree mostly that it's problematic. Right now, yes, it goes through custodians. Imagine the most important stable coins, even if it's a different sector, different use case, and they go to all the physical dollars are held in a specific place. With the gold happens the same. So yeah, there is actually this problem right now, at least. I hope in the future there's going to be a better way to present, to digitalize the various assets. But right now, I agree with you. That's a problem. I don't have a solution for you. In general, that's why it's also, I think, on the other side, seen as favorable by the TradFi kind of sector, because it passed through TradFi. And so it's kind of a place where the pie split between the two sectors. And on the plus side, it helps, I would say the retail investor reducing the ticket to invest, for instance, in real estate in a prime location or to invest in other very expensive assets. So this is pretty much now the takeaway, I would say, but the problem remains with the custodian and so on, and they're very much Web2 right now. Probably in the future, we will see something better coming up, but it's going to be hard.
Is there any other?
Hey, Luca. Thanks for the talk. Actually, it was amazing. I work as a Web3 consultant, and I get different, quote unquote, very curious entrepreneurs wanting to build in Web3 and wanting to launch. And a lot of what they want to build ultimately ends up being wanting to launch a token, so on and so forth. Without keeping the question too long, what's your advice or tips in helping me help them understand that sometimes in tokenomics less is more? And I really liked your last slide that it's not about building the best token out there. It's about building something that is resilient and focusing on one thing at a time. But how do you communicate that to a very enthusiastic business founder that has just read 10 media headlines saying that, hey, if you build in Web3, you're going to make money, right? How do you make them understand that less is more?
Well, to be honest with you, it's also another good question, and it's really hard. It's easier when you have some reputation and you can tell them in the beginning I struggled a lot, but I honestly still struggle. First problem is economics is still a social science and it's not mathematics. Therefore, it's not that I am right and they're wrong. And even if you're the consultant, they're not going to listen to you sometimes, because sometimes founders are very sensitive about strategy and that will mix into this. So this is complicated sometimes for this. I would personally, what I do usually is try to build a layered approach with them, which starts from the foundation of really understanding what their business is about, what's their unique value proposition, what's their mission, what's their vision, what they want to monetize on. Okay, you want to tap that market with a total addressable of 1,000 trillions. Okay, sure. But where do you want to start? Why? Who's going to be your paying customer? How are you going to make money? From there, you start to do some research, state-of-the-art coins and how the Web2 does it, for instance. And then on top of it, you build a design. Usually doing this only in itself give the founder an idea of how complicated it gets. When you have a more layered and like one-by-one approach, you get to their vision. Then when they explain everything to you, they also have more clarity sometimes. And then you attach your advice on token design or in general consultation on Web3, and they're kind of tied to their words that they told you, we agreed on this and that. Therefore, don't you think it's better to do it this and this way? I cannot guarantee you that it works, but this, in my opinion, helps usually to also educate a little bit the client into what they're asking you, because sometimes they're asking you the impossible in a way, like reading the headlines, as you said. It looks very easy, right? We go there, we mean that, done. We sell it, money, funds or whatever. Doesn't work that way, obviously. And again, the more you can be systematic, the easier it is to also for the founder to calm down.
Great, thank you. I'd be interested to know your take on what the demand would be for privacy coins in this space. Purposely built privacy coins.
That's complicated because when I started, there were privacy coins around, Monero, Zcash, and so on, and they had a lot of publicity. I think it's going to be very, very complicated, next to impossible to have them regulated by anyone. And therefore, I think there's going to be always some interest in this, but it's going to be depicted as the interest of terrorists, criminals, money launderers. So I am a bit skeptical that they're going to stick, or they will achieve broader market recognition.
Okay, so we're going to take a question from online. What do you think most Web3 startups get wrong with tokenization?
Yeah, I think the first thing I said about common mistakes, making it too complicated, and also over relying on models and simulations in the beginning. When you don't have proprietary data, you tend to try to create a great model and maybe pay a lot of money in the process, but it's like building a beautiful skyscraper on quicksands. Because the assumptions, sometimes you read these models and I'm amazed. Then I go there and look at the assumptions and I'm like, at least there are 20 assumptions, first of all, and 5 of them are crazy, you know? So this is one of the big problems. Also because then you over-rely on the model sometimes. So you tend to think, I spent this much money to do this model, it looks so cool, it has to be right. So you tend to overcomplicate things also because you kind of have this a sort of mathematic statistic approach backing your reasoning. Sometimes also some companies fish for the data that fits their model, kind of narrating backwards. They try to achieve a certain reasoning, so they just go look for them. This happens also, honestly, in academic research sometimes. So it's not completely new, but this is, I would say, it's
one more from the from online before we go to the last question in the room. How do you balance decentralization with regulatory compliance in token-based projects, particularly in the context of evolving regulatory environments?
Oof, it's not even $1 million question. It's $1 billion question.
I mean, I just tell people to get 4 or 5 passports, you know?
Yeah. I mean, they're a good lawyer. No, it's incredibly complicated. I'm sorry if you can't hear me perfectly. My earbuds died. It's nearly impossible, to be honest with you, because, again, it's true. There is no regulatory structure that is clear right now. In Europe, MiCA is getting there, at least with the purpose of stablecoins and utility maybe. What the big companies do is going to markets where regulations where they don't have security, they don't have capital gains. So if you scale, that's the solution. You go to BVI, you get payments, and doesn't matter if it's a security or not, you know? So you can do whatever you want. And then you can achieve centralization or anything. Look at every big Web3 companies, they're all incorporated somewhere there, you know? For a small project, it depends. It's really you can try and push a little bit farther the token design and wait. But yeah, it's honestly, I don't have the answer, because if they don't give us regulation, I don't know what I can do, you know? The good news is it's getting easier day by day, because now we have some sort of idea of what might be the regulation, especially in Europe and in Japan. Korea is talking about it a lot now. Maybe they will reach a decision soon. Thailand has published something. Dubai has published a lot. So yeah, there is this, but it's still complicated.
Okay, so we're just going to move to the last question here.
Sure, yeah, I have a question. Okay. All right, so in the decentralized world, public networks, everyone is doing whatever they want. They build anything they want, right? So let's say that I work with private networks, right? Blockchains for, let's say, hyperledger fabric framework, right? And I want to put in there a wrapped token for a stable coin. how hard is that to implement a stable coin or a wrapper token that, oh no, USDT, I want to put it on my blockchain private network? How hard will be that? And how much liquidity do I need to make that happen? Have you have any scenarios where you are implementing stable coins in private networks?
Well, usually not many clients ask for, let's say, DLTs, like Hyperledger or Corda anymore. I think it's good, honestly, because I'm not a fan. But honestly, it depends on your own development, I guess. I'm not the right person to ask these kind of things because being the blockchain project being this permissionless and open source, you can just tap into it and create a place where to lock the coins, for instance, and create an image and wrap them and create it on your private network, I guess. But that's more for the developer to do. They have to create a bridge or something like that. It's a question more for an architect than for me.
All right, sorry. Yeah, the reason why I say this is because if anyone can do anything in the decentralized, why cannot I can build my own basically ecosystem, my own blockchain, and I can have everyone in here to come to my store. I have my blockchain. I have many gaming, banking, exchange. So if I provide a better user experience, user interface, better rates. So anyone can have their own ecosystem, their own store, right? So that's why, but I need to have, stable coins to be able to do transactions too, so we can be equal when it comes to, moving money.
Yeah, that's exactly part of the characteristic. This is the building upon the difference between Web2 and Web3 that I was talking about, meaning everything is open source. So it happened already. If you look at, without going to private network, look at Uniswap and Sushi. Uniswap was killing in the decentralized exchange world, and Sushi basically copied the exact same model and built a token on it. You can. That's the fact. In blockchain, you don't compete on IP. You compete on the community you have. That's why I was touching and stressing this kind of point. You compete on how engaged your community is, how happy are they with you. The user interface, as you said, if you have a better user interface, it might as well be that you get the people to come to you. And then the partnerships, for instance. If I can give you access to 100 other blockchain projects, starting from here, and it's seamless, again, the UX is good, better. But yeah, nobody stopped anyone to even fork Ethereum tomorrow and try to add people. They actually tried when I was starting in 2018, 2019. There was like big wars where Roger Ver tried to fork Bitcoin basically and create Bitcoin Cash. Didn't work. I mean, I'm not saying it's not going to work, but you compete on different things. Definitely. IP is not one of them usually.
Okay, perfect. Thank you, Luca. That's a wrap for this session, and we're going to transition into the next one, and we'll catch you on the panel. Thanks.
Thanks. See you later.
You can find information about the Candid Capital Podcast on the website, LinkedIn, and Twitter. Episodes can be found on Spotify and other podcast platforms. A quick reminder that this is infotainment and is not intended to be professional advice, malicious, or hateful. The views, information, or opinions expressed during the podcast are solely those of the individuals involved and do not represent those of employers, partners, and their subsequent connected private and public associations or organizations.
We candid, I hope you understand it. Your business growth, we planned it. Yeah, this ain't for show, we stamped it. Yeah, no FOMO. Everyone come join, no solo. This all factual. From me to you, this Candid Capital.